This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 29, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is flashing green, up a modest plus 0.24% at $740.86, yet the Nasdaq 100 is bleeding out, down minus 0.97% to $675.49. This isn't a healthy divergence. It's a structural fracture where the broad index mask is slipping, revealing deep weakness in technology leadership just 48 hours before the Federal Reserve announces its rate decision. Before we dissect the breakdown, let's lock in the macro schedule. Today is Wednesday, July 29, 2026. The market is bracing for three critical data points. First, today brings ADP employment change and AEP earnings, offering an early look at labor rigidity and utility sensitivity. Then, Thursday, July 30, delivers the heavyweight trio, the FOMC rate decision, the final GDP print for the quarter, and initial jobless claims alongside the PCE price index. These aren't just data points. They are the variables that will force the current defensive rotation into either acceleration or exhaustion.
That FOMC decision is the gravity well pulling all these assets. As we sit at $740.86 in the S&P, the question isn't whether the market will move, it's which direction the weight of the yield curve will push it. We are seeing a clear bifurcation. Capital is fleeing high-duration assets and seeking shelter in low-beta defensives. This is a high-stakes environment where precision matters more than aggression.
Let's look at the tape. SPY at $740.86, Triple Q at $675.49. The spread tells the story. Healthcare, the healthcare sector, is up plus 2.36% while technology, the technology sector, is down minus 1.84%. The VIX sits quietly at 18.67, but silence before a storm is rarely peaceful. Let's start with the broader index mechanics. Grid, you've marked the lines in the sand for the S&P 500. Where is the pressure building?
The pressure is building on a false front. SPY is trading at $740.86, which places it roughly $9.16 away from the 5-day high resistance of $750.02. That is a tight corridor. The issue is that SPY's stability is entirely dependent on non-tech components holding up. If you look at the 10-day range for SPY, support is firmly anchored at $735.21, established back on July 23. We are teetering on the edge of a lower-low structure. A failure to hold $735.21 would confirm that the current uptrend is exhausted. But for now, the index is simply consolidating near the upper bound of its recent box.
And that consolidation is deceptive. You're looking at the aggregate grid, but you're missing the sentiment decay underneath. The VIX at 18.67 might look stable, but it's a static measure. What's dynamic is the internal rot. The spread between SPY's plus 0.24% gain and Triple Q's minus 0.97% decline is a massive disconnection. Institutional capital isn't holding the S&P. They are rotating out of growth beta and into defensive hedges. The sentiment here isn't cautious optimism, it's active capitulation in the tech space. The green tape on SPY is a lagging indicator, not a leading one.
It's worse than lagging, Pulse. It's a liquidity trap. You're calling it deception. I'm calling it a structural breakdown masked by index averaging. The VIX at 18.67 is sitting near the lower bound of its 5-day range of 16.64 to 20.31. That compresses the option premium, making it cheap to buy protection right before the binary FOMC event. The market is pricing in a soft landing, but the yield curve is screaming otherwise. The 10-year 2-year spread is flat at plus 0.35 pp. When you combine that flat curve with sticky CPI at 3.46%, you create an environment where downside risk is asymmetric. Upside is capped by valuation fragility, while downside is amplified by the very real threat of a harder Fed response.
So, we have a SPY that is technically resilient but sentimentally hollow, supported by a VIX that is suppressing fear premiums. Let's drill down into the specific casualty of this rotation: technology. The technology sector is down minus 1.84% today to $171.09. Grid, how does the technical structure in tech compare to the broad market resilience we just discussed?
The structure in the technology sector is actively deteriorating compared to the consolidation we saw in SPY. At $171.09, the technology sector is testing the $170 psychological level. This is a critical juncture because this level acts as a magnet for algorithmic selling. Unlike SPY, which has defined support at $735.21, the technology sector is approaching a zone where there is little historical bid support. If this $170 level breaks, the path of least resistance is downward, potentially dragging the broader QQQ index with it. The volume profile on the technology sector today confirms this. We aren't seeing absorption at these lows, we're seeing continuation.
It's not just algorithmic selling, Grid. It's a fundamental re-rating of earnings power. You're talking about price levels, I'm looking at the cash flows. The technology sector has contracted minus 5.36% over the last week, while the healthcare sector, expanded plus 4.37% in the same period. This isn't noise, it's a deliberate deleveraging of multiple expansion. Look at the bellwether sentiment for NVDA. It's sitting in neutral territory with 63 articles analyzed, showing zero momentum. Without a confirmed upward catalyst in megacap tech, the sector lacks the fundamental gravity to reverse this trend. The market is punishing high-duration assets because the cost of capital remains rigid.
Exactly, CIPHER. And that neutrality in NVDA sentiment is spreading. The fear factor isn't in the headlines, it's in the put/call structures of the sector. Speculative names are getting crushed. Open interest crashed minus 14.9%, and SOFI dropped minus 6% in pre-market. That is aggressive risk-off behavior. Retail and speculators are bailing out of cyclical and small-cap exposure before the big players even finish hedging their tech books. The sentiment shift is absolute. Money is fleeing risk entirely, not just rotating.
Which brings us back to the risk flag I mentioned. The yield curve flatness is the trigger for that fundamental re-rating. A 10-year yield at 4.65% makes those future tech cash flows worthless in present value terms. The market isn't just unwinding positions. It's admitting that the growth models priced into the technology sector at $175 or higher are mathematically unsustainable at current yield levels. Fade the headline green, as Pulse suggested, but understand that the mechanism driving this fade is the mathematical impossibility of sustaining those multiples.
Let's pivot to the beneficiaries of this exodus. Healthcare, the healthcare sector, is up plus 2.36% to $167.26, and consumer staples, is up plus 1.99% to $87.06. These are the safe havens. Grid, do these sectors show technical strength, or are they just catching the falling knife of the broader market?
They are showing relative strength, which is technically bullish in isolation. The healthcare sector is pushing higher while the broader market stagnates, creating a relative performance chart that looks clean. However, we need to watch for exhaustion. If the healthcare sector runs too far ahead of SPY, it often becomes a target for mean reversion trades. Currently, though, the trend is intact. The support levels for the healthcare sector are higher, indicating that buyers are stepping in to absorb supply. It's a classic defensive posture on the charts: higher lows, tighter spreads, and sustained volume. It's not a breakout, it's a siege.
And it's a siege funded by capital preservation, not conviction in growth. The flow data shows institutions moving into the healthcare sector and consumer staples to hedge against the sticky inflation data. With CPI at 3.46%, these sectors offer predictable cash flows that are less sensitive to interest rate shocks. The rotation into consumer staples, plus 1.99%, specifically tells me that investors are prioritizing consumer necessity over discretionary spending. This isn't a buy and hold signal for healthcare. It's a tactical allocation for portfolio defense. The fundamentals support this move because the earnings visibility in staples is superior to tech in a rising rate environment.
But be careful not to confuse safety with opportunity, CIPHER. The sentiment behind this rally is purely defensive. People aren't buying the healthcare sector because they think it's going to moon. They're buying it because they're scared to lose money in the technology sector. Once the FOMC decision clears the air, whatever that verdict is, that defensive capital will flood back into risk assets if the news is dovish, or it will stick around if the news is hawkish. For now, the sentiment score for these sectors is cautious holding. There's no euphoria, no fear of missing out. Just cold, hard risk management.
We've covered the major indices and the primary sector rotation. Let's look at the outlier movers that are distorting the pre-market picture. We have WHLR spiking plus 441.44% and open interest crashing minus 14.9%. SPECTER, how do you assess the risk environment created by these idiosyncratic events?
These outliers are symptoms of a fractured market, not the cause. WHLR plus 441.44% move is likely a low float or biotech catalyst, which is pure gambling volatility. But open interest's minus 14.9% drop is the more telling signal. It's a fundamental miss in glass manufacturing, and the market is punishing it severely. This reflects the broader theme. Beats are no longer sufficient. The market demands precision. When you see a minus 14.9% gap down on an earnings miss, it confirms that institutional algorithms are executing ruthless stop losses. The risk here is contagion. If traders chase the WHLR pump without understanding the liquidity risks, they'll get caught in the same trap that crushed open interest. In a volatile environment like this, with the VIX at 18.67, individual stock risk is magnified.
I agree on the punishment aspect. The severity of the open interest drop correlates directly with the lack of margin of error in current earnings cycles. Companies that guide conservatively and miss by a fraction are being treated with the same hostility as companies that miss by a mile. This validates the flight to quality we discussed earlier. If you can't guarantee your earnings per share, you get sold off. The market is rewarding certainty, which is why the healthcare sector is rising while open interest collapses. It's a binary world. Either you have the defensive moat or you are exposed.
Finally, let's look at the Dow and small caps. Diamonds is up plus 1.8% to $526.89, while IWM is up plus 0.16% to $293.37. The Dow is outperforming, but the Russell 2000 is barely moving. Pulse, what does this tell us about the broader consumer and speculative appetite?
It tells us that the rally is narrow and value-focused. Diamonds' outperformance is driven by industrials and financials, sectors that benefit from a steeper or stable curve, unlike the long-duration tech play. IWM sitting flat at $293.37 indicates that small caps are waiting for direction. They are too dependent on domestic consumption and labor data, with ADP coming out today estimating $2.59 earnings per share. Small caps are essentially paused. They won't move decisively until we know if the labor market is cooling enough to allow rate cuts, or if it's staying hot enough to keep the Fed hawkish. Until then, IWM is just drifting.
To synthesize the view from the desk, we are witnessing a thin rally in the S&P 500, buoyed by defensive sectors, the healthcare sector, consumer staples and value diamonds, while the growth engine, QQQ, the technology sector, suffers a structural breakdown. Grid identified the critical $170 support in the technology sector and the $750 resistance in SPY, but CIPHER and Pulse confirmed that the drivers behind these moves are fundamentally defensive and sentimentally negative. SPECTER highlighted the yield curve flatness as the underlying risk amplifier. The consensus is not a prediction, but an observation of state. The market is hedging. Capital is fleeing tech for quality. The FOMC decision on July 30 is the trigger that will determine if this defensive posture becomes offensive or if the support levels Grid flagged become the new ceiling.
Key takeaways for the session. First, the divergence between SPY and QQQ is the dominant narrative. Do not trust the S&P 500's green tape as a sign of broad health. Second, technology, the technology sector, is facing critical technical support at $170, with fundamental momentum clearly negative due to high cost of capital pressures. Third, defensive sectors, the healthcare sector, consumer staples, are acting as the primary vehicle for capital preservation ahead of the FOMC meeting. Watch the ADP report today for labor cues and prepare for the VIX to expand sharply upon the Fed's announcement tomorrow. This has been the ShadowQuant Equities Edition pre-market session. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.